Today's guest is Bernard Reese. Welcome, Bernard.
Hello, Tom. Glad to be here.
Yes, and thank you for joining us. You are a CPA in New York City. You are the founder of 401k Checkbook and agentfinancial.com. Could you just tell us a little bit about yourself? I know we're going to be talking about some things about really how your customers, the people you work with, one of the things that you really focus on is the importance for people to take responsibility for their investments, no matter who they're working with, to really look at it and take that responsibility on themselves, even though they're working with an agent or working with someone, an advisor. So with that in mind, could you just share a bit of your background, and then we'll jump right into it?
Yeah, glad to do that. So by certification, training, and experience, I'm a CPA, and I do hold insurance licenses and securities licenses as well. I hold several designations. In addition to all that, it's an interesting strategy that people are probably not familiar with. I'm approved by state insurance regulators to manage something called captive insurance. But to sum it all up, I believe that many people are getting fragmented financial advice. Many people out there have a particular product or financial service that they're looking to sell. And people are buying products and oftentimes under the impression they're getting objective advice and not recognizing that they're really within a sales funnel that ultimately leads to a particular product. And in general, there's a high risk of getting something that's not optimized for your situation. And that's what I'm out to do, is try to take an integrated approach and know that, yes, you can work with traditional products, you can work with alternative products. It's really very much about your opportunities, your preferences, your financial profile, and your risk appetite. And people really have to take a step back and recognize that they are ultimately responsible for their financial future. And before they engage any provider, any service provider, or buy any financial product, they've got to recognize that the old adage, caveat emptor, is really applicable.
Yes, I agree. And there, like you said, there are a lot of really good products out there, but do they really fit exactly what the client is looking for? And so I always like the idea of thinking about what is someone's motive for presenting a certain product or presenting a certain solution. And if you can work with that, whoever is offering that, and find out the details behind it and really dig in, that's where I think what you're sharing, the idea of being responsible for what we're doing, we dig in deeper. It's like I would equate it to going to a doctor and just assuming that everything the doctor says is exactly on and exactly right, when in fact you're the best person to know what the symptoms are, and you're the best person to dig deeper and really find out what is it what is the best solution. What is it that because you're going to be the one that knows the best what your own circumstances are. So with that, could you just describe what it's like when you are working with a customer? They come in, they want to work with you. What is that process that you take them through?
Yeah, I'd be glad to. And I think it's good to share an anecdote that really conveys the kind of things that, where people stand to benefit, and have to recognize that the overwhelming majority of folks out there that brand themselves as advisors are really salespeople. And every product has its place. Frankly, there are very few products that are inherently bad or inherently good. It's really just about their application. And to paraphrase the NRA, guns don't kill, people do. And so you've got to realize that every single financial tool is a potent tool. It can work to your advantage. It can work against you. But you've got to realize that there's a person behind that that's promoting it. I'm just working with a client He contacted me. He wants a life insurance policy and structured a particular way. I mean, obviously, he doesn't understand the particulars of it. Life insurance comes in an infinite number of permutations and combinations. There are over 800 life insurance companies in the United States. Each company has an array of products and services. There are so many different ways life insurance can be structured. But this fellow had a very specific agenda and the very particular reason why he wanted life insurance and a goal that he wanted to achieve. He referenced a book, and actually an excellent book, and I'd encourage people to read it. It's a book by David McKnight. It's called The Power of Zero.
Okay.
Now, even before we proceed further, The Power of Zero is ultimately a promotional item. They've got an entire marketing environment. It's all about selling cash value life insurance. And there's a great premise to it. But for people that are not aware of it, they don't realize that they're reading a book that's got great information in there. It really does, and I'd encourage people to read it. But then it's ultimately supposed to lead to a life insurance sale. And there are probably better tools in many cases to achieve the objectives of that book other than life insurance. But in that book, you're not going to hear about those other tools because that book is about selling life insurance and getting you to an advisor that has signed up for their particular marketing program. So in the life insurance space, there's Be Your Own Bank, Infinite Banking, Cashflow Ninja, Paradigm Life, LERP, Leap. It goes on forever and ever. All variations of the same concept, but they're all leading to a sale of cash value life insurance, which in many cases is a great tool, but not always. Now, to get back to what the premise of this book is, which is a great premise, it's about getting into a tax-free zone. The premise is that where tax rates right now are at historic lows. People love to complain about taxes, and taxes are terrible and awful. Who knows where we're headed in the political landscape? I don't know where you fall, right, left, conservative. But with what's going, we don't know with Trump and AOC and all the others out there. Who knows where we're headed? But historically, tax rates have actually been far higher than they are currently. Tax rates have been 40, 50, 60, 70, 80% tax rates depending on your level of wealth in the past. With the Trump tax cuts, for many people, tax rates have further fallen. And we do know tax rates, most of that stuff is sunsetting in 2025, and tax rates are guaranteed to go up within the next 10 years unless something changes. And based on our current national debt and rate of spending, it seems inevitable that tax rates will have to go back to what they historical highs. That being the case, should you be putting money into your IRA or 401k? Well, the idea of IRA 401k is that you put the money in now, you get a tax deduction, you invest for many decades, get tax-free compounding, and when you retire and you're in a lower income tax bracket, you pull it out at a lower tax rate. So you have the benefit of tax-free compounding for decades, incredibly powerful. And then in the back end, you get to take it at a lower tax rate. Well, what happens if you get the tax-free compounding? That's really powerful. That can mean a difference of hundreds of thousands or millions of dollars, depending on the size of your portfolio. That tax-free compound over decades is absolutely awesome. You've actually got to see it in a spreadsheet to appreciate how awesome it is and how that accelerates as you get further into your investment career. But if you're at the back end, your tax rate is actually higher when you take it out and not lower, you may be in for a surprise because you may have had all that growth and then just have to give more of it to the IRS. The way Dave McKnight puts it in that book, you've got a partner in your IRA. It's the IRS. For every dollar that you make, right, all your profit in there, you're going to give some of it to the IRS. And if you think tax rates are going to be higher down the line, then perhaps you're best off not using an IRA or 401k. Great concept. Great
That's
concept.
really an interesting way to look at it. Your analogy or your example of how taxes more than likely are going to go up quite a bit higher down the line, that could have a huge impact on what you thought you had as a huge savings throughout the years.
Yeah, and the concept is powerful. I think it's purely speculative, just like any other any investment. Nobody has a crystal ball. There are so many things, so many variables that can impact where tax rates go. So I'm not actually taking a stand on that one way or the other. But I can understand, I can appreciate, a client that calls me up and says, Bernard, I'm convinced, or at least I'd like to hedge against that possibility, right? I have to, there's certainly a possibility that will happen, and perhaps he wants to protect himself against that. Well, what's the solution for that? Well, the obvious solution would be some sort of Roth retirement account, because a Roth retirement account, be it Roth IRA or Roth 401k, is tax-free forever. So that would be the obvious go-to strategy to deal with this. And for our listeners that are not aware, there are two types of retirement savings vehicles that are available within the tax code. We've got our traditional IRA, traditional 401k, and in those accounts, you get a tax deduction for putting money in. So say your income was $100,000 and you made a $10,000 contribution. For that tax year, your income will be $90,000 rather than $100,000. $10,000 is going to escape taxation that year. It goes into the account. You invest it. The investment returns are not taxed, and they're what we call tax deferred. Down the line, when you take that money out, it will be taxed. But you get the benefit of getting the full investment, $10,000, invested tax-free or tax-deferred, is more accurately, for many, many years, allowing you to get a much larger portfolio. But when you do distribute that retirement account, it gets taxed. So that's the traditional side. The Roth side works differently. So say you earn $100,000, you contribute $10,000 to a Roth IRA or 401k, your taxable income for that year remains $100,000. That $10,000 does not escape income taxation. However, from then on, all the earnings on that $10,000 are tax-free. It will never, ever be taxed again. And that can be very powerful. And to illustrate how powerful that can be, just to use some extreme examples, Max Levchin, Peter Thiel, and Mitt Romney are reputedly have IRAs accounts that are worth hundreds of millions of dollars. Well, IRAs, their investments cost them a couple of $1,000s, and now those accounts are worth hundreds of millions. They invested in startup companies. They had all sorts of alternative investments they got into that are just worth so much more than their investment. Well, for Peter Thiel and Max Levchin, who have reportedly done that within a Roth IRA account, those hundreds of millions of dollars are tax-free. For a fellow like Mitt Romney, who supposedly used a pre-tax IRA, well, he's got a partner in all that. When he pulls that money out, he's going to be paying tens of millions of dollars to the IRS. So for most of us, choosing between Roth and traditional is a nuanced discussion. What are your expectations about the future tax rates, about your future income stream, about your investment performance? It's not obvious. It's obvious in hindsight. Looking forward, prospectively, nothing is ever obvious. And a giveaway that somebody's probably not giving you the best advice is if they speak in terms of absolutes and things are definitive, unequivocal. That's generally not a good sign, because nobody knows what the future holds. Nobody's got that crystal ball. But to bring it back to our discussion and how if you're of the opinion that tax rates are going to be higher, that's a reason to go with Roth. Well, here's the catch. Roth IRAs are limited to $6,000 in annual contributions. You can double up if you've got a spouse. Well, if you'd like to stash away a lot more money than that, tax-free, what can you do? If you'd like to hedge against increases in tax rates, what can you do? And that's kind of the premise of this book. And the solution to that is presented to be as cash value life insurance with a particular. Yeah,
And
go ahead, Tom.
Just to clarify, you said tax-free rather than tax-deferred, and I think that's
Exactly.
one of the key points.
Exactly. That's it. And the solution to that, as presented in the book, is cash value life insurance. And there is a reason why cash value life insurance can be a solution to that. And if structured properly, it can be very powerful. But there's a solution that's not mentioned in that book, right? And of course, as a licensed life insurance professional, I can sign up for their marketing program. You can become a member of their program. They give you materials. You can sign up, give you spreadsheets. They give you templates. And then you can go out and use this marketing tool to sell cash value life insurance. Well, I also set up checkbook 401k plans. Some people call them QRPs, checkbook QRPs. Now, it's good to talk about that. Let's talk about QRPs for a moment to clarify what they are and what they aren't, because there's also been a little confusion about that subject. QRP stands for Qualified Retirement Plan. Qualified retirement plans cover a broad range of tax-advantaged accounts that are created by the tax code, most of them in Section 401. But where these accounts are covered are kind of Section 401 through 415 in the tax code. There are defined benefit plans, defined contribution plans, cash balance plans, 401k plans, profit sharing plans, and a whole range of permutations of these various qualified retirement plans. Now, a 401k is the most well-known of those. And when we set up a qualified retirement plan, a QRP, for investing in alternatives or for people that want a customized plan, in almost all scenarios, we're going to be dealing with a checkbook 401k. For some people that are higher earners, we'll be dealing with cash balance and defined benefit plans. But certainly for investment in alternative assets, such as real estate, we're almost always going to use a 401k-based structure because of the flexibility and ease of administration. So if anybody tells you QRP, what they're referring to is a checkbook 401k. And, well, what the customized 401k, well, in addition to allowing our clients to invest in real estate, in notes, gold, tax liens, private equity, just about you name it, you can do it. We're also able to build in sophisticated tax strategies that you're not going to get in your kind of plain vanilla 401k plan. And we can structure a 401k plan that will enable people to get $60,000 plus per year of Roth money. And that's a game changer. So if you're looking to hedge against increase in tax rates, your answer, the best response, if you qualify for it, may not be cash value life insurance. It may be a checkbook 401k. A checkbook 401k QRP may be your best bet. Now, not everybody qualifies for that. You've got to have certain financial structure, financial profile to qualify for that. But that really is a far less expensive. Our fees to set these things up are absolutely nominal. A cash value life insurance policy, on the other hand, that has all sorts of hidden expenses. Mm-hmm. So this solution is not mentioned in the book. Yeah. Right. And no life insurance salesperson that has signed up for this marketing system is going to mention that. But frankly, they're likely not even aware of it. But even if they were aware of it, I would not fault them for not suggesting it. People should be recognized that when dealing with the salesperson, he's got a product. He's not your advisor. And unfortunately, people too easily conflate advisor and salesperson. Very few people market themselves as salesperson. Most people in the financial space like to call themselves advisors. And that does have a different feel to it, but it tends to obfuscate what's really going on.
Yes. Some really good information. Now, the complexity of the two, insurance compared to what you were just sharing, can you just address that just a bit? Because I think for some listeners, it can be complicated. It can be confusing. I've done some investing through life insurance, but I'm curious what your take is on complexity between the two?
Certainly. When you're dealing with financial tools, they're really abstractions. And almost any financial tool, financial instrument, financial investment has a lot of complexity to it, a lot of abstraction, and a lot of nuance. And most people really do not have the technical know-how to fully appreciate that. So whether you're doing the 401k side or the life insurance side, there is complexity. The question is, how much of it is transparent? How much of it do you actually see? And the challenge being, when you go buy a product, you can go to a store, you can look at a pair of shoes. It's kind of what you see is what you get. With almost any financial tool, what you see is not what you get. People have to be aware of the fact that there's complexity to it. And oftentimes to sell these products, the salespeople have to oversimplify it.
Yes.
Because people will find the details overwhelming. So I don't fault them for not giving them all the information, because for many people that would be overwhelming. So there's complexity to each of them. I wouldn't say one is more complex than the other. We can always go through a quick, we 3 questions, and we can know which one an individual is the best fit for. What the best match is, and then rather go down all the different rabbit holes that are available, we can know, okay, this is what we have to focus on.
I see. And you say 3 questions.
Okay. Do you want to hear those 3 questions?
I'd love to hear them.
All right. So I'm going to take a step back again, and I'm going to give you a little bit of context. So what we're often looking for, when we call our checkbook retirement plans, we've got checkbook life insurance, checkbook 401k, checkbook IRA. So those are the kind of 3 primary tools that we're going to be working with for folks that want to get invested in real estate and other alternatives using tax advantage structures. The checkbook IRA is something that everybody qualifies for. The checkbook QRP, you've got to have a specific financial profile. And the checkbook life insurance, likewise, anybody can qualify for that. Now, between the QRP and the IRA, QRP is definitely more preferable, for a number of reasons. However, that being said, if somebody does not qualify for the QRP, it's something that they do not want. Do not allow somebody that sells QRPs to shoehorn you into something they don't qualify for, because you just may have had a massive taxable event if you set one up and you don't qualify. So you want to make sure you qualify and you're not just getting sold a plan. So the first thing we try to identify is, are they a business owner? Now, a business owner, because in order to have a QRP, you've got to have some sort of business. Business does not need to be a huge enterprise. It doesn't have to be incorporated. It has to be the kind of income on which you'd pay self-employment tax. That's a business. And so that can be, yes, people can have a $10 million business. It could be a $10,000 business. If you're driving for Uber, you're doing consulting, that's a business. So if somebody is a business owner, then we know we may get them into the QRP space. And then we'll kind of put the IRA aside if we can get them into the QRP. Now, on the QRP side, and the checkbook 401k, we're generally focusing on folks that do not have full-time employees that are not owners of the business or spouses of the owners. Now, this is not a rule in the tax code. It's just we're providing these plans that are incredibly affordable. The cost is really nominal. The moment you have employees, there's a whole new set of liabilities and expenses that have to be factored in. And we're finding in practice that many people don't want to undertake those costs. So when it's what we call a solo 401k, an owner-only 401k, an owner-only means owners of the business and their spouses, even though spouses are not owners, then the cost for this is absolutely nominal, and you get total flexibility on the investment and tax side. So the first thing we look to identify is, do they have a business? Are they business owners? Do they have an owner-only business? If there's an owner-only business, we know we'll be talking about the life insurance side, checkbook life insurance, or checkbook 401k. If they don't have the owner-only business, then we know we're going to be talking about checkbook IRA or checkbook life insurance. Then the next thing we'd look to know is, do you have an investment that you've got to fund tomorrow? Because the life insurance play is more, there are multiple structures available, but even the way we structure a policy, if you put $100,000 into a life insurance policy, your cash value at the end of year one is not going to exceed $85,000. That's even at the high end. So that's very high for first year. If you go to your traditional life insurance agent, they're looking to sell you a policy that has the lowest cash value. So we're structuring to have the highest cash value, but it's still not going to be 100% of your investment in a life insurance policy. Life insurance policies have various costs built into them, and you should expect it to take about 6 years for your investment in the policy, for your cash value in the policy to exceed your investment in the policy. And life insurance illustrations are very tricky things to understand. So if you've seen an illustration that looks better than what I've just described, give me a call. So if somebody's got a deal to fund, and we know, hey, your investable assets that you're working with is $100,000, and it's a $100,000 deal, the life insurance is not going to work because you're going to take a $15,000 haircut first year.
Mm-hmm.
But if it's a long-term play, then the life insurance can be the way to go. The life insurance is not tied to having a business that has no limits. It has very few inherent limits. Plan design has certain limits. You can imagine a life insurance company, they sell you a policy with $1 million face value. And then you come back 5 years later, I'd like to change that, adjust that to $10 million. Where they're going to be thinking to themselves, did this guy just get some sort of diagnosis that tells us that this is going to be a good investment for him to have a $10 million life insurance policy? So insurance products are designed to keep the company from being what's called adversely selected against. They're not going to let you change your limits willy-nilly because they've got to think that if you change the structure of the policy once you're in there, perhaps you know something they don't.
Right. Wow. So, yeah, a lot of really good information. So the question that comes to mind with all of this is there are a lot of options. There are a lot of agents, a lot of people, a lot of advisors that sell a lot of products. When a listener is working on selecting an advisor or working with someone, what are some of the key points that should be that one should look for? How does one suss out someone who is really going to look out for your best interest? Now, I know that a lot of this is based on relationship and really understanding how the agent or the advisor is looking out for you. But what are some things that you would say to look out for?
Certainly. There are no absolutes. There are good people all over the place and perhaps people that are less than scrupulous in every area. Mm-hmm. But we want to have some generalizations. I like looking for people that are substantive and that have a background in something substantive, something other than sales, something that requires technical expertise. And I know I am a CPA, so perhaps I'm inclined to think so. But people that come through as an attorney or a doctor, a technical expertise, something that didn't begin strictly in sales. Salespeople can develop technical expertise along the way. Perhaps somewhere along the way they figured, hey, I'll get this designation. It will help me sell more. But fundamentally, where they started is not in an area of analysis. They began in an area of sales. I think it's helpful to work with people that have a solid background. Their foundation is in something analytical and technical. That's one thing I find as is helpful. Another thing is, ideally, you want to work with somebody that doesn't have to sell you a product or is not married to a certain product. If somebody has one particular product to sell, you've got to realize that we are all human, and we all have incentives and alignments of interests, and there's bound to be a misalignment of interest. If there's only one way, it can be a profitable relationship for them. People like to buy products. They feel like they're getting results. People don't like to say pay. And yes, I am a CPA. I am an advisor, and I do have hourly fees. But in exchange for that, I save my clients tens of thousands or hundreds of thousands of dollars from either structuring them in a way that's optimal, or oftentimes from keeping them from doing things that are suboptimal. So I've got people that call me up and say, Bernard, I'm just getting started in real estate investing. And I just spoke to this fellow, and he's suggesting that I get in place this structure with, asset protection trusts, land trusts, personal property trusts, series LLCs, regular LLCs, and domicile in the Turks and Caicos or the Cook Islands. Well, if you've got assets, that may be something to entertain. But if you're just getting started, you're probably better off having an LLC, getting umbrella insurance, and moving on. But ironically, many of these structures that are promoted some of them are structures that people don't need. Ironically, sometimes, people think they're getting the Ferrari. I've seen that go out there. People say, this is the Ferrari of asset protection. This is the Ferrari of retirement plans. You're actually oftentimes not getting the Ferrari. So you actually can be paying more and not getting the best. People sometimes think you get what you pay for. You don't always get what you pay for when you're buying a product. But people like buying products because they feel like they got something. People don't want to pay to talk, and they feel like, hey, I've just paid some money. We spoke for an hour, but I've got nothing. I didn't get anything. I spoke. But there's incredible value to somebody that's knowledgeable in many areas and can guide you to the optimal structure and protect you from suboptimal structures.
Because they have a lot more options to pick from, for one thing.
That's right. Yes. If you don't have a horse in the race, or you have many horses in the race, then you can be objective.
Yes. Now, I know that you focus on helping real estate agents, real estate brokers, people in the real estate investment business. And I know before we got on this call, you had shared that notes, real estate notes are one of your favorite areas to focus on. Can you just share why that is?
Yes, certainly. There are two sides of that. One is as an investment. Obviously, I love notes. And then with regard to the space that I'm heavily involved in, which is the checkbook-controlled retirement accounts, those are my favorite asset class, any kind of debt instrument. So notes can be great. Obviously, you've got to know what you're doing. We're not helping people actually invest. We can introduce them to people, but there are, it's about people taking advantage of the opportunities that they have. So ironically, this is another story that I had. Real estate agent gets in touch with me, referred by a CPA, to get a retirement account set up. And we were going to get them set up with a self-directed retirement account, the checkbook URP 401k for real estate agents, which they qualify for because they're all business owners. They're 1099, the commission, and they can use that, get the tax deductions, and put the money into unique opportunities. So real estate agents know real estate. So they understand real estate, they appreciate real estate, they have opportunities in real estate. It's equity or debt. That's where they live. And try to give them access to that opportunity. When it comes to traditional investing, perhaps many real estate agents don't have that training. And this person, said, I'd like to take a step back. There's a financial advisor that my mother works with. She wants me to work with that financial advisor for my retirement planning. And I said, no problem. By all means, you should go talk to them. And I'd even get on the phone with them. I said, sometimes I get an adversarial relationship with your traditional advisors, but you've got to realize you're going to go to this financial advisor who worked with your mom. Your mom had a desk job at a bank for her career, and she had her unique set of opportunities and financial profile. And yes, she was perhaps best served by having a financial advisor that took her money and put it into mutual funds, diversified funds, and gradually grew her assets. And that may have been the best thing for her. It may be the best thing for you, but you have a completely different financial profile than your parents. You're not a desk job owner. You're not somebody sitting behind the desk typing data into screens. You're out there in the real estate market. You're buying and selling properties. You're helping people buy and sell properties. That can be real estate in and of itself can be the best retirement plan. But the financial advisor is not going to point that out to you. And if you'd like to somehow get tax shielded real estate equity or debt investing inside of a checkbook 401k, that can be the greatest opportunity to you. You've got a unique financial profile as a real estate pro that your parents didn't have. So you've got to work with the structure that's going to be best for you, that leverages your unique set of opportunities. If you go to the financial advisor that's got his Series 7, he's not going to tell you all this. So to bring it full circle, when we talk about retirement accounts, real estate in and of itself has certain inherent tax shields. Real estate can be an efficient, tax-efficient investment, and primarily because of depreciation deductions. However, so when you think about using tax-shielded accounts, IRAs or 401ks, you want to use those accounts for the investments that are the most tax inefficient. So real estate benefits from being inside of an IRA or 401k, but not as much as a debt investment. A debt investment has interest income. Interest income is ordinary income, and you cannot claim a depreciation deduction against your note income. So the optimal investments, the investments that benefit the most from being inside of a retirement account or any kind of tax-sheltered account, are debt instruments. And that's why I say those are my favorite assets, whether you're going to be doing your own private lending, hard money lending, or buying notes and collecting the interest, perhaps tax liens. Debt investing benefits incredibly from tax advantage accounts.
That makes a lot of sense. Yes. So if listeners, we have I'm sure we have a whole spectrum of listeners, the people who are just beginning, just starting out, just learning different things about tax savings and that type of thing. And we have the very experienced veteran investors. Do you have resources or let's just say book or certain resources that you recommend for either side of the spectrum or anywhere in between, where someone can get to that point where they can step up their game in this area?
That's a great question. I tend to read an incredible amount of books. Frankly, I've entertained writing my own book. Being that I'm so technical, though, it's quite a task to undertake. I could never get myself to put out a book that's 75% fluff. It would be really, really technical. Mm-hmm. On our website, 401kcheckbook.com in particular, there's an incredible amount of information. We actually have to hide some of it because it's overwhelming to people. So many different places to go. But if you navigate through the podcasts, webinars, blog posts, all sorts of everything is addressed, from investment strategy to tax strategy. Go to agentfinancial.com. There's a listing, a bit of just, not too much. We haven't put detail there. We've decided to take it easy on the detail. But installment sales, 1031s, there's real estate professional status, so many different things, tax tools and investment tools, opportunity zones, things that are available that people should educate themselves about. On the book side, I tend to read books that are not necessarily unique to what I focus on in particular. It's more about providing the general context and to appreciate that there are many layers, to anything that you get involved in. A great set of books I like is by Charles Whelan. One book that people would benefit from perhaps is Naked Money. And that was really applicable. That was really came in handy when cryptocurrency was kind of had its heyday a year ago. And lots of people, were piling in and questioning it and trying to understand it. Or on an ongoing basis, people thinking about investing in gold. There's a lot of stuff out there. If you read some of these people that sell gold or promote gold, they like to say, the Federal Reserve is printing money at an incredible rate. It's not connected to the gold standard. Buy gold. That's absolute value. Well, if you want a scholarly perspective on that, read Naked Money. It gives you insight into the financial system, the monetary system. It'll change your perspective. Yes, after you read that book, you're probably not going to be so eager to buy as much gold as the last salesperson tried to get you to buy. But you may, be. But it's about getting these differing perspectives and getting a perspective from somebody that's not selling the gold.
Yes.
He wrote a book. He's a professor. He writes, he's a bit witty, so it's engaging. But yes, you've got to be ready to read stuff that's somewhat technical. There's just no way to avoid that. So I think people should read, get educated, and see who is presenting the material. Try to get insight from people that are not trying to sell you something.
Yeah, I'm definitely going to look at the Naked Money book, because I've done some research on money and how money works and the whole monetary system. So it'll be really interesting to hear that, especially like you said, when it comes from a non-biased perspective. He's writing a book from a lot more of a neutral perspective if he's not selling something one could assume.
Yeah, other than the book, I don't think he's selling anything.
Yeah. And I'm really happy to hear that you have such a vast amount of resources on your sites too, because like I say, I know there are some that are going to be just starting out and some that are very, very well versed in investing, but still can learn about a lot more options out there. So could you just repeat those websites again?
Certainly. That's 401kcheckbook.com. That's 401kcheckbook.com. No hyphens, no spaces, no dashes. 401kcheckbook.com and agentfinancial.com.
Okay, great. And we'll put those in the show notes as well for anybody who's driving while they're listening to this.
Yes.
So how about if somebody wants to reach out to you? What's the best way for them to reach out?
I welcome a direct email. You can send that to Bernard at resurefinancial.com. That's Bernard, BERNARD at RESURE financial.com.
Great. That sounds good. And just to recap what you said originally at the very beginning, and that is the importance of taking responsibility for our own investments. Even though we're working with advisors, we're working with other people, understanding what the motives behind the discussion are, what the motives behind the sale might be, and understanding clearly what it is that we really need. Relying on advice from professionals, but not necessarily solely relying on that advice. So, this has been great. Any last thoughts before we wrap it up here?
There's always so much to say. I think this has been really great. I wish everybody incredible success in their investing career and financial pursuits. And it's been great to be with you.
Yeah, and I'd love to have you back on the show again at some point to talk, maybe to really narrow in on a couple of these, whether it's insurance or some of the self-directed options that are out there. So I really appreciate you taking the time here and look forward to talking again.
Likewise, all the best, Tom.
All right. Thank you, Bernard.